This week, the Minister of Finance presented the medium-term budget policy statement to Parliament, and there's been a lot of reaction in the media. The reactions differ in terms of whether the speech was quite boring and whether the budget is in the ICU of a state hospital. I want to speak to both of those. The fact that it was relatively boring shows that the Minister of Finance stuck to his plans. The whole idea of the MTBPS is that it's an update of the main budget plan that he usually sets out in February. So he's not supposed to surprise us with new spending, and he cannot make any new tax proposals. It's simply an update of the plan. Within that update, the minister has proposed some additional spending of about 11 billion rands. And for this, he's moving money around. And it's only critical spending that he's looking at. So he's only proposing to do really essential extra spending. It has to do with e-toll debt to SANRAL and funding of the SANDF's deployment in the DRC. There's also a provision for an early retirement scheme for public servants that's starting next year that he's putting into the 3-year rolling plan. But those are small amounts, relatively speaking. In terms of his tax income, it's clear that he's not going to make the targets that he set in the February budget. And at the moment, it looks like there's going to be a shortfall of about 24 billion rand. This is a lot, but in the bigger scheme of things, not that much. A closer look at that number shows that he's been collecting the company's taxes that he initially budgeted for. And that's in an economy that didn't grow much in the first or second quarter, actually contracting in the first quarter and only growing by 0.9% in the second quarter. Individuals' personal income tax is below target, which shows that companies have not been giving large salary increases, paying overtime, and individuals have been earning slightly less. And we know that there's been an increase in unemployment over this period. The big fall in his tax income comes from VAT and excise, specifically on fuel. And this is the diesel that Eskom used to burn in their open cycle turbines to keep the lights on, that they're not doing anymore. But the state used to earn some tax income off that, and they're not getting that anymore. So in the bigger scheme of things, no clear sign that the economy is doing much worse than it already, the extent to which it was already slowing in February. And I think the minister being as conservative as possible with the reduced tax income and the little bit of additional spending that he's been budgeting for. So maybe the image of the state finances in the ICU is not quite accurate. What is true, though, is that the state finances is suffering from a bout of fever. There's an infection, and it's growing, and it's the debt. And that's why the minister's been really emphasizing managing down the budget deficit and the government debt to GDP ratio. So all his plans up to this point has been these austerity plans aimed at reducing the budget deficit. And in fact, he's budgeting for a primary surplus in order to manage down that total level of public debt to GDP. And in that sense, he is, I think, credibly close to his targets. Now, the primary deficit or primary surplus, in the case of a primary surplus, it simply means that he won't be borrowing to finance current spending, which is already a big step in the right direction and a way to reduce the deficit and eventually the debt. The question to ask, though, is been asked in many circles already, and that is whether the treatment of the patient might end up killing the patient before it sorts out the infection of the debt overhang. And we see that in the pressure on spending in key departments. Before the budget, there was a lot of pressure from the Minister of Basic Education for the Minister of Finance to make additional funding available for education positions that will have to be cut if there's no additional money. There was a similar story around healthcare workers and provincial departments not being able to appoint doctors because there's simply no budget. The minister took a particular hard line on this and say if this is a crisis at provincial level, it's self-inflicted. The provinces decided to use the allocation that they get to pay for the much higher wage increases that the public servants got. But to pay for it, they froze vacant positions, and now they even have to let some educators and medical professionals go because there's no money left. Everything was spent on a salary increase that was higher than the minister budgeted for. Now, you could end up averting a fiscal crisis, but still finish with a service delivery crisis. And that is the key challenge that we are facing. I think on balance, the minister sent all the right signals in terms of his commitment to the idea of fiscal consolidation. So not giving additional money there. There was absolutely no talk of any cost of living relief. He didn't mention the fuel levy. He didn't talk about VAT zero rating. And he said no new bailouts for the public enterprises. So with all of that, sending a signal to credit rating agencies and the foreign buyers of our government debt that he's very serious about stabilizing the budget deficit and the debt to GDP ratio. Unfortunately, though, that leaves South Africans facing many of the same challenges that we already saw we are facing in February. Another big spending iceberg that's out there that he didn't mention is the NHI. So he did budget some money in the February main budget for IT systems for the NHI, but no money to actually pay for the NHI and no information on what the idea is on paying for the NHI. So that's a major elephant in the room. In terms of other macro policies, the minister also didn't talk much, or actually didn't talk at all, about the fiscal target or the change in the inflation target. So afterwards, at a budget breakfast on Thursday, he said that there's no big appetite for a fiscal rule yet, implementing some limit of government spending to GDP or debt to GDP and fixing that, and in a way tying their hands that there's always a limit to their spending. That's still being debated, and we already saw the ANC responding, saying that they're not in favor of this approach. They'd rather look at responsible spending than setting a fixed cap of some kind. He did say that the Reserve Bank has made a presentation to Treasury on changing the inflation target. He didn't say changing it to what, but he did say he wanted more work done by a committee that's currently working in Treasury to see what the cost would be of managing inflation even lower than it currently is. If you're aiming for a target of 4% or 3%, that might mean keeping interest rates higher for longer, or cutting less in this cutting cycle that we're in at the moment. And what would be the cost of that in terms of foregone economic growth? So he's not quite convinced yet, and it's not clear that there will be an announcement in the main budget in February. So in total, I think the public finances are as constrained as they were in the main budget in February. And this is against the background of an economy that barely grew in the first and second quarters of this year. And we'll see how it goes in the third quarter. That data is not available yet. So, but on the other side of the coin, the minister didn't entertain any of the additional spending claims. The extra money that people want in the budget was simply not on the table. He stayed the course of fiscal consolidation. And the story that he tells for the next year and the year after in the 3-year rolling budget is a focus on infrastructure for growth. And the key thing to understand is that he doesn't have money for this infrastructure spending. The money that he does have available is basically just to set the scene for regulatory work that needs to be done. So there are some regulatory reforms that would turn infrastructure, like investing in Eskom's grid, into an asset that asset managers and normal people can invest in and get a return from. So there's talk of a credit guarantee scheme that would remove some of the risk from an investment like that. And then there's all the reforms that are taking place in the electricity market, which means Eskom, NERSA, the transmission company, those reforms to open up to the private sector. And the same story happening at Transnet. But I think the key thing to understand is the minister is not spending much in order to get infrastructure build going. He's creating an environment in which he can draw in private capital. So it's paperwork that needs to change, policies and regulations, and then they need to be implemented and managed, and that's going to take some time. Maybe to finish off, there was some disappointment with the economic growth numbers that the minister presented. But after the president saying they're aiming for 3% over the next 2-3 years, the minister said 1.8. But one has to keep in mind that the minister's 1.8 is not what he would like to achieve. That is what he's realistically hoping to achieve. And it benchmarks his potential tax income. So he can't present a number of 2 or 3% because then he would be accused of inflating his income and making his budget look better by assuming a lot of growth. He's actually, I think the 1.8 is slightly on the high side, considering all the other predictions for growth over the next 2 to 3 years. So if everything works out, if this is credible, if the ratings agencies take this seriously, if the rand strengthens, if inflation keeps falling, then we can get growth going, which would increase his tax revenue, which would make debt to GDP look a lot better, and which would free up some money for him to spend on all those other essential things that the South African public would like to see. Thank you for watching Economics Weekly. I'm Waldo Krugell. If you like to watch more of these videos, comment, subscribe, give us a like. And yeah, if you have any questions, drop them in the comments below. I'm happy to answer them.